Hundreds of institutional shareholders completely sold their Disney stock this year as theme parks and cruises closed around the world. But shares of Disney are up nearly 20% this year as the shift to streaming overshadowed struggling parks and empty ships. With me now by phone to discuss is Bloomberg's Chris Palmieri. Hey, Chris, how is the stock doing so well if confidence in the company was so low at the beginning of the year? Theme parks are closed in places around the world right now with restrictions because of COVID, and of course the cruise business and movie theaters too.
Yeah, it's one of those head scratchers. If you'd have said at the beginning of the year all this was going to happen, you would have sold yourself. But the stock's up almost 22% this year. Way better than the Dow and S&P 500, both of which it's part of. It all has to do with streaming, the wild success of Disney Plus, their service, which was launched a year ago in November. $7 a month. A lot of people around the world picked it up. Almost 90 million subscribers globally in just a year. That's phenomenal. And indeed, the company said last week they expect even more. As many as 250 million. In 4 years out. So just huge numbers. Wall Street loves that business, the subscription business. Everyone paying a particular price per month. It's very easy to model going forward, and so that's really what's driving it.
It's fascinating to see because at the same time you had a lot of smart money earlier in this year get out of Disney stock completely. This is the focus of one of your recent stories on Bloomberg. What did institutional investors tell you about missing this boat?
Well, one is just, intuitively, how horrible the business looked, presently, and, the forecast, for recovery. I mean, when you think about, movie theaters, business can be down about 80% this year. Theme parks, some of which are still closed in California and Paris, and even the ones that are opening are, at best 35% of capacity. No live sports on TV, and what's back is sort of a half a season. So you look at all those factors, and those are businesses that Disney was making money at. It just didn't look good. The other factor is the dividend, which was cut or eliminated rather, and a lot of funds sort of have in their charter that they have. They have literally dividend in their name, and they have to hold a dividend, so they sold.
So they sold because the dividend was cut. So it was just because that they sort of have to invest in these dividend companies, and Disney wasn't that this year.
In some cases, that they literally have in their charter, we can only hold dividend-owning stocks. But many of them do have, some of them say we can have 80% of our stocks pay dividends. But yeah, if you're a dividend growth investor, then you got a problem when there's no dividend.
So has the profile of Disney changed when it comes to thinking about the company because they are investing so much money into streaming and sort of moving away from the traditional focus of Disney, which has been these blockbuster releases and, of course, the parks and resorts?
It certainly changed from a Wall Street valuation perspective. It was, sort of a blue chip company, very conservative balance sheet, a relatively modest price to earnings ratio, price to sales ratio. Now all of those, measurements are through the roof. It's really being valued more like a high flying tech stock, 90 times next year's estimated earnings, 6 times sales, when, it was, just a few years ago, more like 3 times sales. So you're seeing just a huge change in its Wall Street's valuation of the business.
Bloomberg's Chris Palmieri from Los Angeles. Chris, it's always great to have you on the show. Thanks for your time today.
The biggest stories the moment they happen from around the globe. Subscribe to Bloomberg Quick Take now for insight in an instant.